Good afternoon, everyone. We're going to get started in just another minute. We'll give late arrivals a chance to log in, and then we will start in a minute. Thanks so much for your patience. Good afternoon. Thank you for joining us for today's webinar, where we'll break down last year's results and look ahead to this year. My name's Sean O'Brien. I'm the president of QwickRate. Just a couple of housekeeping items before we get started. We are in listen-only mode, so you can hopefully hear us okay, and we can hear you, but you can certainly submit questions that we will address at the end of today's webinar. In addition, I sent out a little note in response to a question. We will be sending everyone a copy of today's slide deck and a link to the recording. I am joined on the webinar today by David Ruffin. David, as many of you are getting to know, joined us in 2019 to develop a new division at QwickRate called IntelliCredit. While we are new to this game, David is certainly not. He has led over 3,000 loan reviews and probably over 500 diligence efforts. So we hope you'll enjoy the conversation today, and also invite you to learn a little bit more about what David's doing here with IntelliCredit. Our agenda for today, we're going to talk a little bit about last year. It does feel like a lot of the economic indicators are improving. We'll discuss bank results. David will touch on what the kind of the uncertainties around credit quality and just the outlook for credit this year. And then we'll tell you at the end just some of the new things that we continue to add to not only QwickAnalytics, but also in IntelliCredit. And then certainly take the questions at the end of the call. Last year, for those of you who joined us in these quarterly webinars, we made a pretty concerted point and repeated point of saying, echoing what the Fed said, which is the path of the economy is really going to depend on the course of the virus. 2020, I always drew on the analogy last year that you think of 2020 vision as having perfect vision, and obviously 2020 was anything but. And I'm hoping for those of us who've been to the eye doctor lately, often you're always given a choice, better here or better there. And I'm hoping that 2021 is better here than better there, which was 2020. A recap of what 2020 looked like from a GDP output. We can all remember, the severe contraction in the first and second quarter of last year, and then we saw tremendous fiscal relief and support put into the economy, and we had a bounce back. But then as that support and relief has started to wane, you can see we have been slipping as we enter the new year. Those numbers are reflected here. You can see we had a big pop in GDP in quarter three, but then we've almost ground to a standstill as the year ended. In total, the U.S. economy shrunk by about 3.5% last year, and as you can see, that's the largest contraction for any full year since the demobilization from World War II in 1946. Debt, certainly expanded. It was the first time that the debt to GDP ratio exceeded the size of the economy for a full fiscal year. First time in 70 years, excuse me. And I think we just have to come to grips with that debt is going to continue to rise for the foreseeable future. Certainly there'll be calls and certainly a lot of pundits talking about debt and inflation. But I mean, honestly, I think at this point we can only tackle one problem, and the problem right now is, restarting an economy that was really ground to a halt. So, what the Fed said last year still remains in force. The path of the economy is going to depend on the virus, and hopefully we're making headway in that effort. I do think it is times like these that this is why governments, should spend to help re-jump and, stabilize the economy. You can see the amount of the deficit, as a percentage of GDP is larger than it's ever been. These are 4 previous recessions, and you can see the amount of of the budget deficit thrown at it to try to increase jumpstart the economy during peacetime. And again, it speaks to how large the economy is and how much money it really needs to take to get this thing going again. All that's really kind of more of us in our daily lives is really about jobs, right? We need people working in our hometowns. You can see earlier last year we had some really big numbers as the stimulus, or I should say really more relief and support hit. And then as the year dragged on, it started to wane. And that's why we're looking for more fiscal support because, if you look at the last quarter of the year, we essentially created, less than 100,000 jobs for the economy. That's just not going to get it done. And so when you hear people say, long-term scarring, the longer it takes to get back to the pre-pandemic levels of employment, the worse the effect is going to be on all of us, including our customers at our banks. Depending on whose forecast you listen to or look at, most have the economy recovering those jobs by the end of either 2022 or sometime between that and 2024. Long-term unemployment's really, the other issue that's still out there lurking. The number of people who've been unemployed for greater than 27 weeks continues to be a large number, and it's not really falling or coming down. It's been very stubborn. January we saw employment grow in a number of areas, and still we see it falling in other areas. So again, it's going to be, as we've talked about in previous webinars, this is very industry specific. Industries where you need to gather, where you need to be in person, they have been severely impacted. They need the most support now. But again, hopefully when that comes, then we'll see job improvements in most areas of the economy. Certainly nothing happens overnight. I do think there's the risk is doing less than actually doing more. And again, you always try to keep things pretty simple. So if you think about how many jobs the economy creates on a monthly basis, it really tells you, kind of when things are going to recover. And so if you use the idea, if we create 200,000 jobs a month, it's going to take almost 4 years to get back to the employment levels we had at February of 2020. If we can create 300 jobs a month, now we're down to a little over 2.5 years. So we really do need the relief and the support from the government to get this economy going again, so that people will be able to find jobs and kind of get us back to where we were before all this started. So where does that leave us? I think I'm always kind of a glass half full person. I mean, I feel like I'm a director in a small community bank in Illinois. We had our board meeting this morning. I feel our outlook is better than it has been. So I think there's still obviously uncertainty and challenges ahead, but every day we get closer, hopefully, to an end to this. So, we're keeping our fingers crossed. I think if you look across the board, most banks, while they didn't pull back provisions, they're lowering maybe the expectations. We saw that particularly with many of the money center banks and regional banks took smaller provisions in the fourth quarter. Some even pulled back some of their reserves. So I think there's some, continued reasons to be positive. Net charge-offs remain low. Banks did build reserve balances through 2020. We got another round of PPP loans. There's certainly plenty of capital and liquidity in the system. Hope in an improving economic forecast. And then, housing has been a source of strength throughout the country. There's clearly a shortage of homes in most markets, particularly ones in larger metropolitan areas. So that's been a source of strength for borrowers. And then in the fourth quarter, late in the third quarter, and then in the fourth quarter, we saw a real improvement in bank valuations. And so again, that probably will spur some M&A activity in 2021. But I think all speak to the fact that there are signs of improvement. Since we used J.P. Morgan last year in a number of these calls to talk about what they did with their reserves, this is a page out of QwickAnalytics where you can kind of see their quarterly progression with the loan loss reserve. Looking, at 2019 and the end of the year, they're at 137. Took it all the way up to 329 as a percentage of loans, and now, has has tapered off to just over 2.85% of loans. So I think that's what a lot of banks have done. We built the reserves, and now we're starting to roll over a little bit and kind of take a wait and see of what's going to happen here in 2021. I think all that has led to a increase in consumer confidence. This is the University of Michigan study that the St. Louis Fed tracks. You can see the low in April of last year of 71.8. We've been chopping along for the last 9 or 10 months, but we're slowly increasing. So hopefully all of this will provide some tailwinds as opposed to headwinds as we go through 2021. So again, what do we know? Where are we going? I'm always a big believer in it's impossible to forecast with certainty or accuracy. So I always want to try to just be directionally correct. And so if I'm thinking about what's positive as I look out into 2021, I think the outlook for COVID's better. I mean, clearly the last few months have been awful in terms of the number of deaths and number of cases, but people are slowly being vaccinated, so that's a positive step. There's clearly work to do, but it feels like efforts are certainly moving in the right direction. Winter's coming to a close. I'm in Illinois today, so I wish it was tomorrow, but literally and figuratively, I think spring will bring confidence. It'll get us out. Hopefully, more people vaccinated, and normal starts to be something we can actually start to feel and plan around. As we mentioned, consumer confidence, I think, is slowly rising. I don't think there's any question interest rates will continue to stay low. While they're arguing about the amount, there's certainly more support relief coming. As we touched on, a new round of PPP loans, the housing market and the stock market remains strong. So a lot of really positive factors. What's uncertain still is credit quality. We really don't know what the true state of many of our borrowers are. Main Street and a lot of the retail and service industries are clearly very wounded. While it won't be an overnight cure, hopefully the healing starts in 2021. And then we still have a number of people long-term, reaching that long-term unemployment that we want to keep in the labor force. And again, hopefully, build a stronger economy as we move forward. The Atlanta Fed, I took their, quarter one forecast. It's pretty strong. Again, depending on who you listen to for your forecast, they're a little bit all over the board, but I would say that they are increasingly, optimistic. Some have pulled back some of the optimism, but we're certainly moving in the right direction, and we'll just have to continue to follow the virus for the fate of the economy. So as we pivot to what's going on with banks, closed the year with just a little over 5,000 banks in the country. Again, we always make the distinction for community banks. We look at every bank, but we also always want to focus in on the community bank sector, and that's what we call the QwickAnalytics Bank Index, the QCBI. The number of banks you can see here of those 4,700 community banks, the distribution has changed quite a bit from last year. Last year, at the end of 2019, there were 202 more banks between 0 and 100 million. So not surprisingly, everything in our industry is getting bigger. There were actually 158 more 100 to $500 million banks, and there were actually 64 more, 64 fewer 500 million to a billion. So that has increased. The number between 1 and 5 billion has increased by 103, and there's 9 banks between 5 and 10 billion that are from last year. So, again, a lot of challenges for every bank. For smaller banks, it's increasingly so, and we kind of see this just continuing to, shrink the smaller banks and make the bigger banks bigger. Asset growth, as we all know and experience, was kind of strong across the board. 3 out of 4 banks saw 10% asset growth last year. In terms of loan growth, again, pretty solid. The surprising thing here is that 27% of the banks didn't see any loan growth. And so strategically, again, that's a challenge for smaller banks, is where do we find our loan growth going forward, particularly as more borrowers are going to have some scars from yet another recession. Deposit growth at QwickRate, I don't have to tell you, all of you have money, plenty of deposits. 4 out of 5 banks essentially saw greater than 10% deposit growth. So again, a lot of the PPP money, ended up in your banks, which is great. So as I mentioned earlier, we really do enter 2021 as an industry with a lot of liquidity and a lot of capital. Some of the performance numbers, again, these are things I'm sure you're all experiencing. We had with lower interest rates, we had borrowers asking for, obviously on renewals and just refinancing loans. We saw yield on loans roll over by 31 basis points. The cost of funds improved by 25 basis points, but net our NIM still saw a contraction of over 28 basis points for the year. So, I don't have to tell anyone on this call, right? That's for a community bank, we're primarily NIM driven bank. That's painful. So we're going to have to continue to find ways to be more efficient, to do more with less, and hope the economy picks up so that we can continue to see good, strong, loan and asset growth as we move forward in 2021. Non-interest income has just kind of, stayed relatively flat for the past 5 or 6 years. And, the efficiency ratio tells a good story, right? Over the last 5 or 6 years, we've continued to whittle away at it as an industry. I think it speaks to banks looking for technology where they can to improve just their day-to-day operations. And I think what we're trying to do here at QwickAnalytics and IntelliCredit is in that same vein, right? Just trying to give you more efficient tools to do more with less at your banks. Some other 2020 versus 2019 performance numbers. The number of banks who saw an increasing ROA was about 1 out of 3, and about 2 out of 3 saw their ROA decrease in 2020. Obviously, almost every bank in the country saw asset growth increase, and then NIM, again, a little over 4 out of 5 banks saw their NIM contract. So, the other, I would say strategically concerning thing is around loan to deposits. We hit some decade lows in terms of loan to deposit percentages for community banks. And I think the challenge here is increasingly in some of the smaller markets as a lot of our loan customers get disintermediated away, finding ways to, say yes to our customers. And I think coming out of this crisis, it'll be more imperative, as we've mentioned on this webinar before, that you find ways to be able to say yes. And for many, that's going to be making sure you have a, SBA or government guaranteed lending outlet. Because again, for many borrowers, particularly in the service industries, if they're going to come back and try to get in business, it'll probably require some kind of SBA or, government guaranteed loan effort. Whoops. Pre-tax ROA rolled over, not surprisingly. Core operating earnings, which is, again, kind of a pre-tax, pre-provision type of analysis. We think that's a good measurement, good across the board, apples to apples measurement of bank performance. That rolled over more slightly. I am encouraged that, for most banks other than the 100 and under, pretty strong median numbers across the board, both for pre-tax ROA and core operating earnings. Median ROAs and ROE, again, you can see here, the ROA number rolled over, as did ROE. And again, you can see, looking back to 2017, what a difference the tax cuts made for the industry. So, hopefully, I wouldn't expect any tax increases for most of us this year, but, again, certainly something to have on our horizon because, it did have a hugely positive impact back in 2017. At this point, I am going to turn the presentation over to David. So if you'll bear with me and bear with us 1 second while I pass the control to David. He will take the second half of the presentation. So David, hopefully you can take that now. Yes, he'll take you through. Thanks, David.
Hopefully you can see that.
Yes.
So great. I think thank you very much, Sean, and I think for all the things that Sean shared with us on the call today, the operative word for credit and credit quality within our portfolios has to remain uncertainties. And why is that so? Certainly 2020 was a high performance banking year. Virtually every bank outperformed financial expectations, certainly given where they were being thought through in April or March of last year. The banking Armageddon that was feared at the advent of COVID just simply has not materialized. And credit metrics at a 10,000 foot levels arguably show nothing onerous has occurred. There are a lot of temptations, as basically Sean has already alluded to many of them, of why, as an industry, we could claim victory. We're just that good in managing our institutions through this national disaster and made money doing so. We're clearly the beneficiaries of years of building more capital. Certainly the vaccines are coming, and presumably the worst is over for COVID. And certainly, unlike a decade ago, no blame can be ascribed whatsoever to our industry. In fact, just the reverse, as I think particularly the community and regional bank space has gotten huge plaudits from a public relations standpoint with the handling of the PPP programs. So as the late radio and television broadcaster Paul Harvey used to say, and when he would pivot mid topic, now for the rest of the story. We have experienced, as again Sean alluded to, unprecedented regulatory relief, massive federal economic stimulus in the early months of the pandemic, a flush of deposit liquidity and non-organic loan growth in the PPPs and SBA initiatives that continue now in the second wave of PPP in the early part of 2021. But I think as I talk to bankers, and I know particularly the credit managers and the risk managers in the banking world, just intuitively know that all credit tales have a way of outliving the economic shocks that frankly bring on the advent of a new credit cycle. And of course, the federal government lifelines eventually will have to cease. As again, Sean alluded to, our commercial credits, and I wrote an article in December to this effect, it's posted on our website. Our commercial bank credits reside on Main Street, not Wall Street. And Main Street indeed is in a recession, and that always is an issue. And a key issue that is a credit metric we always look for in traditionally is that many of our borrowers are more focused on their own survival than investing for growth, which again, normally in and of itself is a credit red flag. So 2021 credit realities, all the largely government COVID initiatives, while avoiding an economic calamity, have aligned to create what I believe to be the greatest masking of effect of underlying credit risk in modern banking history. Again, unlike the last crisis, where we had primarily one industry, everything related to 1 to 4 family housing, and to look to as a hotspot. Probably the most vexing legacy of COVID to the banking industry is the effect it has had on putting giving us a landscape where many divergent industries have been negatively impacted, further complicating our risk assessments as bankers. Certainly, we've had significant impact from a variety of perspectives with all stakeholders of banking relative to credit. Boards and management, obviously, it's anathema to boards and managements to have too many surprises for obvious reasons, and particularly to the outer world of investors and regulators. Risk managers, it's absolutely their role in careers to try to assess, quantify, predict, and mitigate and minimize credit risk. And certainly when you talk to investment bankers and the investment community as a whole, there again is what is perceived to be unprecedented levels of uncertainty as to what the short to intermediate to even longer term impact on credit quality will be to our portfolios. And regulators, in my belief, and I certainly have had some one-on-one conversations with banking regulators who have indicated they certainly felt compelled to give some space to the bankers in 2020 to deal with this disaster. But there is already a strong presumption that 2021 will become a much more normalized examination process, and not only that, there will be a strong expectation for a very proactive role taken by bankers to explain what is the COVID effect embedded in their portfolio. Again, uncertainty is anathema to managing credit risk, and I believe that reducing these uncertainties, not eliminating, we can't ever eliminate risk in banking, but we can certainly try to minimize or reduce them, will be priority one for at least the credit specialists and managers throughout 2021 and perhaps beyond. Other challenges remaining for us to deal with, I think at some level we may be caught in some production of documentation on what appears to be some increasing investigations of some PPP fraud that unfortunately inevitably went on, particularly during the first round. CECL is not going away. I know some people actually were hoping that one of the first victims of COVID would be CECL, but not to be, even though it got pushed out a little bit, particularly for the smaller banks. It's clearly not going away, and I think that is still something we have to transition into. The regulators reminded us just last week that 2021 is a transition away from LIBOR, so hopefully your documentation and disclosures are appropriately being changed. And of course, there's continuing focus on anti-money laundering and Bank Secrecy Act, as well as cyber risk that just constantly we live with. And then I think finally the inexorable question is how long the tie to government to both abate our risk and enhance our growth, which is absolutely the intellectually honest truth about what we've had as an industry. So let's talk about some national and regional metrics in credit performance. And again, thanks to our sister company, QwickAnalytics, we're going to use some of these to just depict 5 key regional aspects of performance, as well as the national being the blue line. Just in the nature of these 3 charts alone, and I have had this thought for many, many years, that in the simplest of terms, this is, you have your inventory of problems and you can do one of 2 things with it. You can charge them off or you can reserve for it. I think just the eye glancing at these 3 is the real headline coming out of year-end financial numbers for banking, and that is our NPLs have continued to decline, which is certainly surprising 7 or 8, 9 months ago. Charge-offs are minuscule, even at all existent, and then reserves continue to increase. So I did, just as an aside, I was talking to a banker the other day, and he made the comment that, our NPLs have actually decreased significantly by year-end 2020. And I said, well, and I knew him well, so I knew he wouldn't be offended. I said, how many of those were the beneficiary, or how much of those is your bank the beneficiary of applying the extensions or modifications? And he said, you caught me. So my point there is that was another example of a regulatory relief allowing the industry, and perhaps your bank also, to lower its NPLs in such a way that still begs the question, is that really on a short or intermediate term a true reflection of credit as the after effects of COVID continue on, as we say, on Main Street? Another way of looking at this is the inverse of the reserves to our inventory of problem loans, and that is, in this case, the West is covering 315 basis points of acknowledged inventory of problem loans. Nationally, it's about 2.5 times. So again, we have adequate reserves, and even in a look back of the COVID 2020 year, you've clearly got a lot of coverage that has existed here. So we have loan growth trends, as Sean alluded to. They're largely in the $10 billion banks and below. They're largely coming from banks north of 500 million. But as you can see on the chart to the right, as of the third quarter FDIC numbers, there was actually some close to negative loan growth in at least in that. The real spike up came in the second quarter when a lot of the PPP loans were documented. Concentration risk, again, this is mainly the CRE or the broader CRE at 100% guidance, and the construction and development, 300%, the subset of that construction and development, the 100% guidance. No real regional differences to speak of there. Suffice it to say there are 144 banks nationwide that exceed the 100% guidance. And then there's 233 banks on the broader 300% guidance. Again, that's a guidance, not a regulation. While regular concentrations, again, is absolutely critical for us to continue to look at, and not just real estate, is the FDIC published a wonderful study that they commissioned last July, which did a postmortem on all the failed banks of the last financial crisis. And not surprisingly, findings were greater than 70% of those banks had significant CRE lending. They also had concentrations of what we call late cycle vintage, which means, again, proving empirically that loans made late in a healthy credit cycle often tend to become the most toxic because they lack seasoning, and in some cases they may be the products of a lot of aggressive lending and witting or unwitting reduction in underwriting standards. There's also, again, none of this is earth-shattering, proven high correlation to collateral dependence, which coincides with default rates. In other words, the worst of both worlds. Whenever you need collateral to help minimize your loss, usually the marketplace has handed you a devalued piece of collateral. And of course, there were state and regional market forces that proved to be critical covariants in this. Another depiction of this is why this is interesting for CRE. So many community and regional banks maintain still significant exposure in CRE lending, have been for years. This is for all banks. And as of about 2019, exposure was on par with residential lending. I don't have data for this, but I would surmise that the banks under $10 billion would have even excessive CRE lending to residential lending. So again, we all know the impact of COVID on traditional office space, and we all know the impact on COVID to traditional brick and mortar retail. And all of that needs to be factored into not just quarter by quarter, but strategically what's going on in your portfolios in the next 2 to 3 years relative to these longer term impacts that have been exacerbated by the COVID effect. Other concentrations, of course, would be things like multifamily, C&I, and ag. C&I largely, again, that's what I often refer to internally as funny money because it really does not reflect organic growth. It was more or less the big spike up largely because, of course, of the PPP loans. So there are changes afoot in lending that I perceive that I wanted to share with you. I think we're certainly beginning to look at a new paradigm of what a prospective borrower looks like. The traditional pool of traditional prospects has clearly shrunk because of COVID for the things we've all been talking about in this presentation. I do think there's an opportunity to convert PPP loans into a more stable organic loan pool, again, taking advantage of the fact that there's so much goodwill that's been generated by community and regional banks stepping up to the plate and being exceedingly active in the delivery of PPP loans. And I think in that sense, we can, particularly unlike a decade ago, we as an industry can really begin to take some credit for the COVID recovery when it begins to occur. And I think also that we take the fiscal stimulus and the regulatory relief off the table for a minute. Just embracing government guaranteed programs for loan growth, I think, is absolutely a legitimate strategy going forward, and increasing your level of activity with SBA lending and so forth and so on, because clearly it's got advantages like, it gives you more organic loan growth. It, as we said, provides continued goodwill, certainly has profitability from the fees and secondary market sales associated with that type of loan. And of course, that's all presuming the efficacy of the guarantee is in place. We still can't forget the need to be sure that the paperwork's done and the I's have been dotted and the T's crossed relative to our work to expect the guarantees to be honored. So in terms of credit risk management aspect or the risk side of the lending equation, I think we're already beginning to pivot away from the COVID-related modifications. We are in the second stage of the PPP loan generation. I do think there's some assessment of talent going, reassessment of some talent going on in terms of if, and that isn't a big if we get a swell of true workout credits that begin to rear their heads in the next year or two, we're going to have to look for more workout talent, which frankly has not been needed for a number of years in banking. Clearly having to maintain a close borrower contact virtually, of course, during this environment. I'm a strong advocate, again, I think I shared this with you last quarter, tweaking your policies, making them more relevant to the unique and uncertain experiences you're dealing with right now. Many policies may not have been really modified in years, and they may reflect a totally different lending environment. The reason for that is we all know the regulators, understandably and justifiably so, hold you accountable for your policies. And what you don't want is to inadvertently give them traps on the divergence between your stated policy or procedures and your performance in the last few months, even though understandable given the COVID. Certainly, I think, excuse me, focusing on conservatism without overreaction. And I think the last point there is really interesting and critical is I think we will be as an industry focusing more on reserves and charge-offs, as was often the knee-jerk reaction in the last crisis, largely because we have so much more capital in place to justify that. We also need to absolutely refocus on the, both the quantity and the quality of our loan reviews. That was took a big bit of a was victimized to some degree with COVID as well. Most banks I talked to had some aspect of their original intent in terms of coverage on loan reviews at least reduced during 2020, and arguably a time that would need that to be very vibrant and effective for you. M&A was mentioned by Sean, and I think there is more predictions for certainly more robust, particularly in the second half of 2021 in terms of M&A. Again, I want to say, again, investment bankers I speak to still grimace a bit over the unprecedented levels of uncertainty in underlying credit. It's clearly beyond just one industry this time. Loan impairments are really not part of the vernacular anymore, as they largely drove credit marks in the past. I think there'll be a lot more of the what if scenarios done and forced through an M&A process than we may have seen before. And I think a lot of focus, as has been the case in the last 2 or 3 years, focus on really cultural synergies, not just the credit mark itself. But even the mechanics of calculating the ever-present credit mark may change. We think that may well be a change more to a broader definition, if you will, of what a net charge-off has been, largely because that's been skewed to some degree by recoveries. What I'd like to kind of close with for my segment is to suggest 5 key strategies to reduce 2021 credit uncertainties. One is to recognize the trap of you focusing only on portfolio at large credit metrics or performance. You can then be too stuck in looking at the forest for the trees, if you know the kind of the downside of that perspective. There's too much in our broader credit metrics at this point in time that can lull us into a sense of comfort without understanding what is going on in the subsets. As I alluded to, this is the great legacy of COVID. It is requiring us in all banks, in my opinion, to create a mindset that our whole portfolio is made up of the sum of many parts. And those many parts may indeed be performing in quite different perspectives. And therein lies the secret, I think, of managing credit risk, which is identifying as quickly as you humanly can emerging credit risk. And I do think that that is clearly, and the way you do that, of course, is to identify all sorts of subsets relative to industry codes, generalized concentrations, and how they relate to both your general concentrations as well as certainly to capital. Anything you're using relative to assessment of a broader macro or aggregate credit trend should give you the ability to immediately identify and isolate and segregate those stressed or troubled borrowers that are creating those trends, good or bad. And I think also, as I just alluded to, adopt some alternative portfolio servicing protocols in this environment. That includes really focusing on a much more enhanced loan review deliverable for your bank. In the end, I think that the key point is you create a credibility and a capability rather at your bank to write your own script. This will be all about 2021, in my opinion. You being ahead of the outside world of investors, you being ahead of the regulatory community, and being able to see that you have the ability to write your own script. Now, how do we do that in IntelliCredit? Follow me for just a moment in terms of just the concept of how we go about that. And first of all, we start with the concept of you've got public data. Of course, that comes with everything that Sean alluded to with QwickAnalytics. And then you have the real source of information that we spend most of our time with at IntelliCredit is the non-public data that comes out of your loan portfolios. In kind of a hierarchy of how you go about this and use this either peel the onion or drill down concept here is you start with red flags, which are obviously at the highest or macro level of your portfolios. Then start identifying aggregate portfolio trends that may be giving you some concern. Again, be able always to drill down to the individual borrowers or groups of borrowers, relationships that are comprising these trends. And then again, what we have done, I think, rather revolutionary at IntelliCredit is to do what we can to bring loan review out from the cold to deal with and treat it not as a one-off engagement, but make it part of an integrated real-time assessment of your bank's portfolio. And of course, all of this done with the ability to do that. And remember, the external stakeholders in banking see you through the lens of public or call report data. Only you are privy to your non-public idiosyncratic loan data. And there may be a lot of need and opportunity in 2021 to use that non-public data to maybe change some perceptions rather that are coming out of the public data. I think that's one. Not only does it give you heads up on early detection, but I think it also gives you the ability to, again, write your own script. And voila, you have that already in place with the combination of the QwickAnalytics and the IntelliCredit. So in conclusion, what are these 5 key strategies of giving you value? Again, it confirms you as captain of your own ship. A former regulator told me years ago that they use this 4 square matrix on banks from time to time to try to assess how cooperative or how competent they are. In that regard, what it does help you in most is minimizing credit surprises. I don't know of any more toxic event between bank management and bank boards than a sense by the bank board that they're getting hit too often by credit surprises. And with all the uncertainties we've alluded to in today's presentation, I think that, again, it would be a benefit of maybe applying or at least looking at these 5 key strategies. It also, in conclusion, supports the proven correlation between early detection of emerging credit risk and your ability to reduce your levels of loss and non-performance, and most as importantly, giving you the flexibility of managing problem loans out of the bank. We all know if you wait too long, that problem sticks with you, can't be moved. And again, I think the magnitude of today's credit uncertainties certainly adds to your challenges for 2021, but they certainly can be overcome. Sean, I'll hand it back to you to close.
Okay, thank you, David. I'll just bear with me 1 second. I'll pull my screen back up. Okay, thank you, David. just kind of my final two thoughts on this. Again, we're very excited to have David and his team and what they've built at IntelliCredit. We really encourage you to take a look. Everything we utilize today in today's presentation comes from QwickAnalytics, which many of you have seen or perhaps attended a webinar, had a demo on it. But we're really in the aggregation of data business. We want to put information on your desktops to give you more information so you can spend time analyzing data, not aggregating data. We've taken that next step with IntelliCredit, as David pointed out, where you can really take your own idiosyncratic information and, again, analyze it rather than aggregate it. 2021, we will continue to make enhancements to both QwickAnalytics and IntelliCredit. On the QwickAnalytics side, one of our on our CECL solver, our portfolio level CECL solution, we will help calculate that WARM. We're going to develop a CAMELS page, which will highlight a lot of the financial metrics that support the different CAMEL ratings. It'll show quarter over quarter and year over year changes. We've already built out an investor relations page. We'll continue to modify it. And then our add-in tool, which many of you use, we will be adding credit union data to it. I know we get a number of requests beyond just the bank level data to have credit unions. We don't have them on the interactive pages, but we will be utilizing or providing that data in the add-in tool. And then certainly I would encourage all of you to share templates that you'd like for us to build within the add-in tool. I think that's another area of focus for us as 21, is to not only just provide you with the data, but potentially build some templates. So if you have ideas on that, anything you want to share or collaborate with us on, we're all ears and would love to get your feedback. We also just introduced in the last couple of weeks with the fourth quarter numbers, an industry credit research tab within QwickAnalytics. This allows you to research any of the loan categories, look at different banks and research groups, including peer groups. You can actually overlay FRED data, so if this can work in conjunction with our CECL tool for Q factors. But again, just allows you to access and utilize all the available industry information that we have contained in QwickAnalytics and make it a little bit easier for you to create output at your banks. As I mentioned, you can add national QCBIs, state QCBIs, and overlay those. So a number of different ways to drill down into that data. For those of you who've seen our stress test, we've updated it. We've made it more interactive. We've given you the ability to customize some inputs. We'll be doing another webinar on this in the first half of this year. You can still run your traditional report, but again, we've created more ways for you to factor in not only PPP loans, other government guaranteed loan, make changes to peer groups, other financial assumptions. You can factor in internal capital target levels. But as we enter a period of uncertainty, one thing that's worthwhile to know is what kind of capital cushion you have should some credit challenges befall your bank. So the credit stress test is really designed to better identify for you and for outsiders what that level of credit cushion is in multiple scenarios. So I'd encourage you to take a look at this, and we're happy to walk you through and your team on a demo with it. As I mentioned, you have the ability to factor in capital raises, put in your own internal capital targets, and also make changes to any of the financial numbers we use in the assumptions, including loss rates, time look-back periods. That was one of the real questions we got from a lot of our existing users was, hey, we used in the previous model or tool, we used 2009 and 11 as our loss periods. Now you have the ability to customize that to whatever you experienced as the most detrimental loss periods in the past. So just a lot more knobs for you to turn to hopefully develop a much more meaningful report. As I mentioned again, the credit union data should now be available in the add-in tool. So we're looking forward to that. Investor relations pages for our banks that have a ticker symbol, or even those who just want to have more information available for their investors. We really kind of capture a lot of the information already available in QwickAnalytics, but then allow you to customize it with your own information to create a page that looks something like this, that can include stock prices, overviews, other releases, listings of disclosures and officers, directors, and shareholders, and really ultimately anything you want to share with outsiders about your bank. So that is available as well. I hope you see and continue to see. Again, thank you very much for your time today. Thank you for working with us at QwickRate for these so many years. But we are continually trying to build affordable, easy to use solutions. We have a real strong belief here that it's not worth it if banks can't actually employ the technology. There's a lot of fintech out there. There's a lot of choices. A lot of them are hard to implement. We've tried to make things that you can slide right into what you're doing today, hopefully make you and your team more efficient. We really believe we've done that with QwickAnalytics, and I know we've done that with IntelliCredit. So, we'd encourage you to kind of take a look at either one of them, get a demo, see what it can be. And then as you think about your next loan review, we'd respectfully ask that maybe you give us a chance to quote on it, and we can show you how not only have we improved that process with our IntelliCredit solutions, but you can also get a glimpse of our portfolio analyzer as well. So we'd love to quote one for you and just show you a little bit more about what we've built, particularly with David and his team. For those of you who aren't aware of IntelliCredit, again, we have a couple of cloud-based applications, including a portfolio analyzer and a smart loan review that can benefit you both in your internal and external processes. And then, as we mentioned, we are available to do your next external loan review should you be interested. David, anything there you want to add on either of those before I move on?
No, I think that covers it, Sean. Absolutely. We'd be glad to talk with anyone on the distinctions between or among those.
Thank you. And again, we make the process easy. We'll take all the data that you have, whether it's a core export, a flat file, or alert file export, any sources of data that you got around your loan portfolio, we'll aggregate those and put it into a tool that you can utilize to really mine your own loan portfolio for data.
Well, I will say this, Sean. I will say this. Sorry to interrupt you, but everything we're hearing from people that are using this process are just wowed by the efficiencies of it. And I think, again, as you alluded to, efficiency is in the name of the game, and we certainly are dedicated to contribute to that for all of our clients.
Thank you, David. I couldn't agree more. Finally, with QwickAnalytics, we'll continue to try to add to the already pretty long list of things how we think we can help banks, not only from a bank and peer performance, in-depth analysis of your bank and every other bank in the country in an apples-to-apples way, and then we continue to try to find regulatory tools that we can, both that are helpful, but that can save you time and money as well. So, again, encourage you to take a look if you haven't looked at us recently, because we continue to make changes. Finally, we do have another webinar next week just to talk a little bit about QwickAnalytics and how we think this can be deployed in your bank and how it can help. So we'd invite you to join us for that. I'd also encourage you to continue to look at our site for upcoming webinars. We'll be running a first quarter webinar like this in I guess it'll be May. So we'll look for you and hope you'll join us again for an update on what happened after Q1. And then finally, would just remind you, one, thank you very much for attending. I know it's all very busy this time of the year. Thank you for taking time out of your day to join us, and ask you to, if you have time, take a tour of either QwickAnalytics, IntelliCredit, or both, and we'd love to show you what we continue to build. I'll leave this screen up a little while longer, but thanks again for all your time and patience today, and we'll look forward to speaking with you soon. Bye now.